Welcome to Introduction to Financial Management. This is Irine Maliwanag, an MBA 104 student of AMA Education Online. This section is about the role of financial management divided into the following topics: 1. Introduction, 2. What is financial management, 3. The goal of the firm, 4. Corporate governance, and 5. Organization of the financial management function. At the end of this lesson, we will be able to explain why the financial manager's function is vital nowadays. Explain financial management in terms of the three primary decision areas that the financial manager must deal with. Determine the firm's goal and why shareholders' wealth maximization is favored over other objectives. Recognize the issues that can arise when the corporation's management and ownership are separated, i.e., agency problems. Demonstrate a firm grasp on corporate governance. Discuss the issues that underpin the company's social responsibility. Understand the differences between a treasurer and a controller, as well as the essential tasks of financial management. In the 1900s, financial managers primarily raised funds and managed their firm's cash positions. Then, in the 1950s, the increasing acceptance of present value concepts encouraged financial managers to expand their responsibilities and to become concerned with the selection of capital investment projects. Today, the financial manager plays a dynamic role in a modern company's development. The financial manager has emerged as a team player in the overall effort of a company to create value. Through efficiently acquiring, financing, and managing assets, the financial manager contributes to the firm and to the vitality and growth of the economy as well. There are several external factors impacting the role of the financial manager, but not limited to: heightened corporate competition, technological change, volatility in inflation and interest rates, worldwide economic uncertainty, fluctuating exchange rates, tax law changes, environmental issues, and ethical concerns over financial dealings.
In this video, you are going to learn the roles of a financial manager. Let's start the video. The financial activities of a firm are one of the most important and complex activities. Therefore, in order to take care of these activities, a financial manager performs all the necessary financial activities. A financial manager is a person who takes care of all the important financial functions of an organization. The person in charge should maintain a farsightedness, in order to ensure that the funds are utilized in the most efficient manner. His actions directly affect the profitability, growth and goodwill of the firm. Following are the main functions of a financial manager. 1. Raising of funds. In order to meet the necessity of the business, it is important to have enough cash and liquidity. It is the responsibility of a financial manager to decide the ratio between debt and equity. It is important to maintain a good balance between equity and debt. 2. Allocation of funds. Once the funds are raised through different sources, the next important function is to allocate the funds. In order to allocate funds in the best possible manner, the following point must be considered: the size of the firm and its growth capability. Condition of assets, whether they are long-term or short-term. The method by which the funds are raised. These financial decisions directly and indirectly influence other managerial activities. Hence, the proper allocation of funds is one of the most important activities. 3. Profit planning. Profit earning is one of the prime functions of any business organization. Profit earning is important for the survival and sustenance of any organization. Profit grows because of many factors, such as pricing, industry competition, state of the economy, mechanism of demand and supply, cost and output. A healthy mix of variable and fixed factors of production can lead to an increase in the profitability of the firm. These areas are all managed by the financial manager. 4. Understanding capital markets. They traded shares of a company on the stock exchange for continuous sale and purchase. It is understood that the capital market is an essential factor for a financial manager. Hence, it is the responsibility of a concerned person to understand and calculate the risk involved in this trading of shares debts. If you want to read in details and download the PDF, go through the link in the description. If you find the video helpful, give us a like, share the video, and don't forget to subscribe to Education Leaves.
What is financial management? Financial management deals with acquisitions, financing, and management of an asset with a comprehensive goal in mind. There are three decision functions of financial management, namely, first, investment decision. This is the most important of the firm's three major decisions. It begins with a determination of the total amount of assets needed to be held by the firm. Second, financing decision. This is the second major decision. Here, the mix of financing should be decided, and the financial manager must determine how best to physically acquire the needed funds. And finally, asset management decision. Once assets have been acquired and appropriate financing provided, these assets must still be managed efficiently.
Hi, I'm Sean Pinder from the Department of Finance. It gives me great pleasure to provide you with this introduction to one of the key financial decisions that people face on a day-to-day basis, the investment decision. Now, this is a decision that needs to be made in a whole host of different contexts, including personal investors trying to work out whether they should include a particular company in their investment portfolio. Alternatively, a factory manager who needs to decide which machine will maximise the company's wealth. Or even a multinational organisation considering the hostile takeover of one of their competitors. All of these decisions involve answering the same basic question. What impact will the decision have on wealth? Be it the wealth of an individual or the multinational conglomerate company. But before being able to answer this question, we need to be able to work out what it means when we say that a project creates wealth. So let's consider this with an example. So let me tell you about a seemingly great investment opportunity that I have for you involving property in far north Queensland. Now, this investment will require you to invest $1 million today, and in return you'll receive $400,000 at the end of each of the next 3 years, plus you'll receive the $1 million back at the end of the third year. So that's a final cash flow of $1.4 million. Now, you might be immediately suspicious because this investment is promising a 40% return each and every year. But you're reassured by the fact that independent auditors have signed off on the claim that this does represent an accurate measure of the expected returns from the project. Well, what can we say about the project? Firstly, is the project expected to be profitable? Well, first we need to define profit. Profit is defined, in an accounting sense, as revenues minus expenses. That is, do you get more out of a project than what you put into it? If the answer is yes, then absolutely this project is expected to be profitable. Because we invest $1 million, but the project generates cash flows of $400,000 per year, plus we get the initial $1 million back at the end of the third year. So that suggests that the expected profit over the project's entire life is a cool $1.2 million. That is 3 lots of $400,000. But does the project create wealth for us? Well, to answer this question, we need to remind ourselves that money has a time value. And in order to value a project, we can't just add all the cash flows together. To illustrate what we mean when we say that money has a time value, let's answer the following question. Which would you prefer, $1 today or the promise of $1 in a year's time? And the answer, of course, is that you prefer the dollar today. And there are 3 reasons for this. Firstly, the dollar today can buy more than the promised dollar in a year's time because in the presence of inflation, we expect prices to rise over the next year. Secondly, if you have the dollar today, then you can do something with it and invest it so that in a year's time you'll have more than $1. So there's an opportunity cost associated with delaying receipt of the dollar. Thirdly, the dollar in your hand today is certain, whereas the dollar promised in a year's time is uncertain. That is, it's risky. The way that we allow for the time value of money in finance is by discounting future cash flows back to their present value today, using a discount rate, R, that reflects inflation, opportunity cost and risk. So what does that mean for our current project? Well, let's start with the assumption that this is a very risky project. In fact, on average, other projects that have this level of risk have an expected rate of return of 50% per annum. So the discount rate that we'll use to assess this project is the rate of return that compensates us for risk, opportunity cost and inflation, and in this case that's 50% per annum. To work out the wealth impact of this project, we simply discount back each of the cash flows promised by the project and then add the discounted amounts together. When we do this in the current example, we find that the sum of the present values of all of the future cash flows netted off against the initial investment required of $1 million is minus $140,740. Or put another way, if we invest in this project, our wealth will decrease by over $140,000. So this is a very poor investment. Intuitively, this makes sense as we know the project was promising 40% per annum, yet the benchmark for a project of this type was 50% per annum. This approach of discounting future cash flows back to their present value today is part of a family of investment evaluation techniques known as discounted cash flow, or DCF. Studies have shown that DCF techniques are the most frequently used project evaluation methods employed by corporations around the world when assessing new projects. The specific DCF technique that we've applied in this example, where we have netted off the initial investment against the present value of the future net cash flows, is known as the net present value, or NPV technique. And the decision rule for this technique is very simple. We simply accept all projects that have a positive net present value, because these projects have an expected return that more than adequately compensates us for the impact of inflation, opportunity cost, and the risk inherent in the project. Conversely, we reject all projects with a negative NPV, because the rate of return they are promising isn't sufficient to compensate us for the impact of inflation, opportunity cost and risk. The investment decision faced by investors is a decision about which assets they should invest into. It's a decision that investors face in many different circumstances. From an individual's decision about what shares they should hold in their investment portfolio, to a factory manager's decision about which machine should be purchased, to the multinational corporation's decision about whether they should launch a multi-billion-dollar hostile takeover bid of a competitor. The key criterion that the finance professional uses in making this decision is whether or not the investment will increase the wealth of the investor. We've demonstrated that wealth creation is a quite different concept to profitability. Specifically, for an investment to increase wealth, the returns expected from the investment need to adequately compensate the investor for the time value of money. That is, inflation, opportunity cost, and the risk inherent in the project. The most popular approach to allowing for these three contributors to the time value of money is known as the discounted cash flow, or DCF approach, where we discount future cash flows back to their present value today. The specific technique of netting off the initial investment required against the present value of the future expected cash flows is called the net present value, or NPV, method of project evaluation. Hi, I'm Sean Pinder from the Department of Finance. It gives me great pleasure to provide you with this presentation on a key decision that finance professionals around the world face on a day-to-day basis, the financing decision. That is, how should companies structure the financing to enable the purchase of an asset? In reviewing this decision, we're going to concentrate on two key questions. Firstly, what effect might the financing decision have on the wealth of the owners of the new asset? Secondly, what are some of the factors that might encourage or deter firms from adopting particular forms of financing? To illustrate the impact of the financing decision, let's set you up as the prospective owner of a new business. This business involves the brewing and delivery of craft beer throughout the city of Melbourne. You anticipate that you'll need $2 million of capital to set up your business. Now, fortunately, you will already have saved $1 million on your own, but you need to work out where to get the additional $1 million. There are two options that are available to you. You can bring in a partner, Jerry, who's an entrepreneur, who's keen to take a 50% stake in the business. Alternatively, you can borrow the $1 million from Susan, your friendly corporate banker, who's willing to lend you the money at an interest rate of 10% per annum. So, on the one hand, you can take on a partner and use their funds to fund the business. Now, this is a form of capital known as equity capital. The alternative that we have in this example is to borrow the money from a bank, where these funds are referred to as debt capital. The next step is to analyse the wealth effects of these two alternatives. But before doing that, we need some measures of the possible performance of the business over the next year. Now, let's assume for the sake of this illustration that there are 3 possible states of the world that will materialise over the next year. The expected outcome is that the business delivers net cash flows, after all operating expenses, of $300,000. The other 2 possibilities are that things will turn out fantastically well for our business, in which case we forecast a net cash flow of $600,000 at the end of the year. Whilst on the downside, if the market for craft beer tanks, then we expect that our business will only generate $100,000. Now let's have a look at the impact of the different financing choices on your own returns. So let's have a look at what happens if you take Jerry in as a partner. Not unexpectedly, what happens is that the net cash flows that are generated by the business are split equally between the two of you, so that your claim on the cash flows range from $50,000 in the poor state of the world up to $300,000 if we outperform expectations. Now, because we contributed $1 million to the business, we can express these cash flows as a rate of return, ranging from 5% to 30% for the year. Now let's look at what happens if you use debt capital instead. The key with debt capital is that lenders get paid their interest before the owners of the company can claim a return. In this example, the bank set an interest rate of 10% on a loan of $1 million, and as a result, the interest paid by the firm, no matter what state of the market we face, is $100,000. In the poor state of the world, all of the cash generated has been captured by the bank, leaving us with a return of nothing for the year. Under the expected state of the world, only $100,000 out of the $300,000 generated is paid out, and you get to keep the remaining $200,000. Whilst in the great state of the world, you get to hold on to a whopping $500,000. So what's going on here? Here we have a table summarising the rates of return generated on your $1 million investment under either of the 2 financing scenarios. Firstly, if we take Jerry on as a partner, your expected return from your $1 million investment is 15%, and your returns will range from 5 to 30%, depending upon the state of the market for craft beer. If you borrow from Susan at the bank at a rate of 10% for the year, then your expected return is higher at 20%. This will always be the case if the rate of return expected to be generated by your assets is greater than the interest rate charged by lenders. Now, the next thing to notice is especially important. You can see that your returns are much more volatile or riskier once you introduce debt onto the scene. Now your returns will range from 0% to 50%, a much greater variation than if you had have taken Jerry on board as an equal partner. This increase in volatility is what we refer to as financial risk, and simply reflects the increase in the variability of your returns as a consequence of introducing debt as a source of finance. The final point to make with respect to this example is that we've ignored taxes here, but more on this in a moment. So what are some other influences that we should account for when considering why investors make the financing decisions that they do? In addition to the impact of introducing debt on the financial risk of the firm, there are a whole host of other influences on the investor's financing decision. For example, some assets provide better debt capacity than others. That simply implies that lenders are willing to lend more funds to an investor with assets that are easily sold off if the investor gets into financial distress sometime down the track. For example, tangible assets like warehouses or real estate or delivery trucks and so on, these are relatively easy to sell off. On the other hand, other assets such as trademarks or goodwill or other examples of intangible assets represent a much more difficult prospect to sell off and pay back debt. Another influence on an investor's decision to borrow funds from a lender is that the lender might actually impose certain restrictions on what the investor can and can't do with the money. And they may also restrict how the investor conducts their business into the future. Now, this can lead to an investor shying away from borrowing money and instead preferring to use equity capital. Our third example of another influence is the impact of taxes. Interest expense in Australia is deductible for tax purposes. Now, this means that any dollar paid out as interest can be claimed as an allowable tax deduction, thereby reducing the cash generated by the company's assets that is lost to the government. Now, this can help to explain why historically firms around the world have been attracted to using debt, even when they have sufficient cash on hand to not only fund all desired projects, but to also pay back much of their outstanding debt. This characteristic of debt is known as the interest tax shield, so called because the interest deduction claimed reduces or shields them from the tax that the investor would otherwise have to pay. In this presentation, I've introduced you to only some of the issues that investors consider when making a decision about how to finance the acquisition of an asset. Now, we've only scratched the surface here. There are a whole host of other financing decisions facing investors. Decisions such as, if we're going to borrow funds, should we borrow using long-term or short-term debt? Should we borrow at a fixed or at a variable rate? If interest rates are lower overseas, should we consider borrowing there rather than borrowing domestically? Or if we're not going to use debt but raise equity instead, should I bring new partners in or just reinvest the funds that have already been generated by the asset? Or, thinking on a grander scale, perhaps we should consider listing our business on the stock exchange. And then we can look at raising capital by issuing shares out there in the market. All of these are serious questions that require finance professionals to be equipped with the tools necessary to provide practical and timely advice to investors, be they sole traders of a small home business or multinational, multi-billion-dollar conglomerate companies thinking about how best to structure their financing to maximise the value of the company's assets.
Did you know in automotive industry alone, the amount of downtime can cause a factory to lose up to $1.3 million an hour? So that is why asset management is very important. Take for example, in manufacturing, you need to make sure your conditions of machines are in tip-top. You need to make sure your raw materials are there whenever you need them. In healthcare, there are things like biomedical assets that you need to maintain, calibrate and sterilize. Otherwise, you risk contamination, you risk patients are not being treated on time, you risk losing revenue for your healthcare industry. In retail, you need to make sure your trolleys, for example, are well maintained so that the shoppers, when they come to your stores, are able to use them to shop more. You need to make sure your unmanned stores infrastructure are in tip-top condition so that you're able to manage and measure your clients that are coming into your stores. So those are the tip of iceberg, on asset management that will be very helpful for all industries.
The goal of the firm. Efficient financial management requires the existence of objectives or goals. 1. Value creation. Management must focus on creating value for shareholders. It requires management to judge alternative investment, financing, and asset management strategies in terms of their effect on shareholder value, Share price. Management should pursue product market strategies, such as building market share or increasing customer satisfaction. 2. Agency problems. This is about the separation of ownership and control in the modern corporation, results in potential conflicts between owners and managers. And 3. Corporate social responsibility.
Every business, every for-profit business is basically designed and built and started to provide return to the shareholder. This is what we call shareholders value or creating shareholders wealth. That's a fundamental truth, right? So ultimately, business has to achieve that purpose. But in today's complex business models, it's not easy. So first of all, profit maximization has transitioned into value maximization, and value is a much broader concept. And you need a lot of stakeholders into it. So it's not that simple just to create shareholders value. That's why we talk about customer value and employees and other stakeholders. So we'll talk a lot more detail about it. But what is value in a nutshell for the purpose of this program? Value is the difference between the benefits enjoyed by a firm's stakeholders and its cost to produce those benefits. Very simple, right? If you just focus on it, then you will get to the crux of this strategy management. Who are the stakeholders? Not only shareholders and not only customers, but also employees and suppliers, and also society is part of the stakeholders. And what is a strategy in this perspective? A strategy is simply a game plan to create value. Very simple. That how do we take all these components of the business, how do we take these stakeholders, and how do we put them together in a meaningful way to create and maximize our value? That's all about a strategy in a very simple nutshell. It's a value proposition of a business. And value creation is not one way in this case. Value creation is really mutual between all the stakeholders, except shareholders. Shareholders, as I said, the fundamental principle of any business is to create shareholders value, end of the day. But before we reach there, there is a lot of interaction between different stakeholders, value creation for the business, value creation for them. So this flow explains that. Okay, based on this quick understanding of these principles, there are a couple of things to really comprehend at this point of time. So value creation process is twofold. Generally speaking, most business models are based on creating shareholders value through customer value. Most businesses understand that customer is a very critical part of the value creation process. How do they do it? They create twofold principles. Number one, they create high quality product and services, which creates customer value, right? Makes sense. And then and then sell those services and products at a price that results in profit, which will create shareholders value. Now look at these two principles very closely and look at some of the most successful business models. That's exactly what they are doing. Companies like Apple, companies like Amazon, companies like Google, creating high quality product and services and making it available at a highly competitive, acceptable price. Because now which one is more challenging? First, people would look at these two principles and say, first one is really challenging, creating high quality product and services. Really? That's very simple. You put more resources and you can create more compelling product and services. Easy, right? Simple formula. But the main challenge is, more challenging part is how to sell those product and services at a price that creates shareholders value. Because if you don't create shareholders value, the whole purpose of the business model is gone. It's collapsed. So really, selling at a price to result in profit, that's the main challenge. And company like Apple and Amazon is doing fantastically. Apple is creating amazing, fantastic products and making it available at a price which is affordable. People are happy to pay that, right? Now, look from a finance professional's point of view. Where we are, as I said, this is the crux of the successful business models. Creating high value product and services, creating customer value, and then selling at a price which results in profit. Where we are, finance professionals. We are entirely focused on the second principle. That's what we call financial management. That looking at the revenue, looking at the profit, looking at the cost and saying, this is profitable, this is not profitable. It's very easy for you to go to the marketing department and tell them that these are the products you're selling at loss. Really? We don't understand the full value creation cycle. We are not there. We are even not close to the first principle, high quality product and services, creating customer value. And that goes hand in hand. You cannot manage one or the other in isolation. They really go together. And that's what the business or strategy management is. So I know that all of you are very have high level of expertise in managing profits, prices, revenue, but really we need to understand how the high quality product and services are created, how they are positioned, how they are creating a high value, perceived value in the customer's mind, so they could pay a high price or affordable price for that. So uh, when you see these slides, just contemplate on these things also. And then based on this, we talked about some of the key roles of the strategic CFOs, like if that is really the game of the success for successful businesses, what a strategic CFO has to do: understand what drives value, right? Measure the value and then minimize the leakage of that value. Very simple, but very broad. And not many CFOs are doing that role. Not many. There are exceptions, but not many are doing that. What are we going to do now? So if you really understand that paradigm, and you said that, okay, I'm willing to go into that value creation part and play my role as a strategic CFO, what you need to do, these are the various steps we'll be covering this program. So build up your strategy knowledge and skill first. As I said, our education, traditional and professional education, is not providing us with enough tool, number one. Number two, the things are changing so fast, so rapidly, that we need to keep learning. Even if you have attended a strategy program maybe 5 years ago, probably you need to learn it again because it's changing very fast. And then step by step, initiate strategic conversation. Very important. You can only do the strategic conversation when you are knowledgeable, right? When you understand things deeply. And then conversation also extend to making presentations, developing your brand, doing some trainings, and then getting involved in the strategic projects and really initiating an idea and own and drive strategic projects. Approach here is that we'll go module by module, covering different strategy models and framework. Now, there are hundreds of books on strategy, if not thousands. And they have diverse approaches, different ways and approaches to learn strategy. I have picked an approach which is easier and faster to learn and apply, especially for the finance professionals. So my design of this program is meant for finance professionals in mind. The models I have chosen to develop your strategy knowledge and your brand are easier to understand based on your financial background, like balance scorecard, like value chain analysis, like enterprise performance management. You will pick up very quickly on these things. The number one thing is for this program is to transition you into the role of a strategic CFO. How? By developing a deep and practical knowledge of the subject of strategy. That's very, very clear, number one. Number two, creating a personal brand. So not only that you develop knowledge, but the world needs to know, your business associate, your CEO, your other people need to know that you are a strategy professional. How would you do that? You will actively take part in a strategy conversation. You will getting involved in the strategy projects, and you would drive a strategy project. So that is how we'll achieve the objective of this program. And some, as I said, you will start doing it during the program. Some you will do after the program. Okay, so my promise in this program is this would be the most valuable business learning of your lifetime. This 3 months would be the most valuable business learning. Number two, you will develop a fresh mindset, a new mindset. How do you see your role in solving business problems? So it's not financial, it's not accounting, it's a business professional. How would you really solve business problems? A fresh mindset. And number three, your confidence to actively participate in a strategic conversations at the board level. So as I said, for your personal branding, it's very important that you demonstrate your knowledge. It's not about your MBA or executive MBA degrees. Nobody cares about that, but your practical knowledge, and that you could only establish by active conversation. So these
Some facts about agency problems. The separation of ownership and control in the modern corporation results in potential conflicts between owners and managers. The objectives of management may differ from those of the firm's shareholders. We may think of management as the agents of the owners. Shareholders, hoping that the agents will act in the shareholders' best interests, delegate decision-making authority to them.
In this topic, we'll be looking at the firm in terms of the agency relationships that are involved. An agency relationship exists whenever you delegate decision-making rights to someone else. Those decisions by the agent impact on the welfare of the principal. In this story of the firm, we'll start with the shareholders. These people have money, and they want to get a return on it. Smart shareholders will have investments in lots of different firms. For their investment, they want a separate legal entity, partly because it gives them limited liability, and they want a firm that has unlimited life. The shareholders provide the money, and they get a share of the firm that they can sell to someone else whenever they want. But shareholders don't have the time, the expertise, or the interest in managing the firm, so they hire professional managers to do that. These managers specialize in knowing about the business. And there is one more character in this story, the debt holders. For various reasons, it can be cheaper to get money from debt holders than from shareholders. One of the reasons is the debt holders get paid before shareholders. That means there's less risk for debt holders, and so the cost of getting money from debt holders should be less. So debt holders provide funds, and they expect to get their money back plus interest. The interest covers the time value of money and the risk that the loan will not be repaid. Now that we know the actors, we can turn our attention to their motivations and the agency problems. Agency problems exist because the self-interest of these three characters, which we can refer to as principals and agents, don't align. Let's look at the shareholder-manager relationship. The shareholder, with a diversified portfolio of investments in many firms, wants the firms to take a chance. That's because you can't get a good return without taking some risk. Sometimes the risk won't pay off. But the shareholder has lots of investments, and so, on average, they expect greater risk to generate greater return. In contrast, the manager can't diversify. She's committed herself to the firm. If it goes bust, her job is gone and her reputation is likely to suffer. So the manager is risk-averse. This difference in appetite for risk creates the risk aversion problem. The shareholder wants risk, and the manager wants to avoid risk. While we're talking about risk, let's consider the debt holder. Remember, the debt holder has a fixed interest. They get their money back, plus interest, to compensate them for the risk that they won't get paid, but they never get any more than that. The debt holder has assessed the likelihood that they won't get their money back and set the interest rate accordingly. If the firm uses their money to purchase more risky assets, the debt holder is less likely to get their money back. And that's not all. If the assets do lead to a higher return, the debt holder is no better off. They'll only ever get their debt plus interest. So, the shareholder wants to use the debt holder's money to purchase risky assets, because the shareholder has all the upside if it goes well. The debt holder has all the downside if the risky asset doesn't pay off, and none of the upside. We call this the asset substitution problem. Managers are also interested in building the firm, which is their empire. Their salary, their reputation, and their comfort often increase by keeping any surplus money in the firm. If they can't get a return that's greater than what the shareholders can get elsewhere, then the shareholder would rather have the money returned to them as dividends. For shareholders, this is the dividend retention problem. Debt holders also have an issue with dividends. When money is returned to the shareholders, it reduces what's available to pay the debt to the debt holders. When debt holders lent the money, they assumed that assets exceeded liabilities by a certain amount, which gave them confidence that there would be enough money left over to pay them. If the firm pays excess dividends to the shareholders, then it's the debt holder that may lose out. While we're at it, remember that if the firm doesn't have enough money to pay their debts and goes broke, there is an order in which debt holders are paid. The problem of claim dilution occurs when the firm borrows more money and puts the new debt holder higher up on the order of payment in liquidation. The final problem relates to the life of the firm. Remember, the corporation has unlimited life. The share price should reflect the future cash flows into perpetuity, in other words, forever. So the shareholders' interest in the firm is their share of all future cash flows forever. On the other hand, managers retire and managers die. That changes their outlook. Managers need to see the money now. This is called the horizon problem. Managers have no incentive to put in effort or make decisions that will benefit the firm after they're gone. The last problem between the debt holders and the firm also relates to the life of the firm. When everything goes bad and the firm doesn't have enough money to pay even all of the debt holders, then there'll certainly be nothing left for the shareholders. When that's the case, any additional work or profit made by the firm is going to go straight into reducing the shortfall for the debt holders. That's good for the debt holders, of course, but it does nothing for the shareholders, so there's no incentive to do any work or engage in any projects, even if they have a positive net present value. Remember to think about the implications of these problems for accounting. Accounting provides the basis for the contracts that are used to manage these problems, and to evaluate performance, which creates the opportunity for ex post settling up.
Now we go to corporate social responsibility. Protecting consumers, paying fair wages to employees, maintaining fair hiring practices and safe working conditions, supporting education, and becoming involved in environmental issues such as clean air and water are all examples of corporate social responsibility, CSR, that management should consider. Management should take into account the interests of stakeholders other than shareholders. Creditors, employees, customers, suppliers, communities where a company operates, and others are among these stakeholders. The firm's ultimate goal of maximizing shareholder wealth can only be achieved by paying attention to the legitimate concerns of the firm's diverse stakeholders.
Corporate social responsibility and branding, promoting good and increasing profits. Being socially responsible doesn't just make your company look and feel good, it also makes good business sense. Policies that help make the world a better place have the potential to boost company revenues, increase customer satisfaction, and cut staff. But how? More than half of consumers say they're willing to pay more for products and services from companies that are committed to having a positive social and environmental impact. That's especially true for millennials, the 75 million strong generation. Of those willing to pay extra for sustainable products, 51% were millennials. So is your company ready to embrace social responsibility and take advantage of the opportunity? If so, here's how to get started. First, make social responsibility part of your company's DNA, making choices that help the environment, employees, and communities. In 2010, consumer goods giant Unilever announced its Sustainable Living Plan, committing to halving the environmental footprint of its products by 2020. The results have been striking. Its sustainable living brands grew at twice the rate as the rest of the company, and Unilever's employee engagement and reputation have risen since it started its Sustainable Living Plan. Conversely, companies that act irresponsibly could pay a price, with a tarnished reputation, fines and litigation, and even boycotts and lost sales. The next step is to focus on causes that align with your business. Coffee giant Starbucks pledged to source beans grown ethically and sustainably, and buy from suppliers that provide safe, humane work conditions. It's important to remember that your social efforts should complement the company's primary business mission. Another essential step is to engage your employees in the effort. Companies with social responsibility programs often attract highly qualified young candidates and have lower turnover. That's because millennials are considered the most socially engaged generation since the 1960s. They want to work with purpose. Finally, get the word out. If you use organic ingredients in your product, your customers need to know about it. Use your commitment to corporate social responsibility for recruitment efforts. Given the choice, most consumers want to buy from companies that engage with the outside world. Committing to do good and following through on that promise could be one of the smartest business investments you can make.
What is corporate governance? Corporate governance is the mechanism through which corporations are administered and controlled. It includes the company's shareholders, board of directors, and senior management relationships. These connections provide the framework for establishing company goals and measuring successes. The effectiveness of corporate governance is thus dependent on three groups of people. First, the common shareholders who elect the board of directors. Second, the company's board of directors. And third, the senior executive officers led by the chief executive officer, CEO. The board of directors is the vital link between shareholders and managers. It's the most effective tool for good governance. and it responsible for the company's oversight. When functioning effectively, the board also serves as an independent check on company management. The role of board of directors sets company-wide policy and advises the CEO and other senior executives, who manage the company's day-to-day activities. One of the board's most important tasks is hiring, firing, and setting of compensation for the CEO. Boards review and approve strategy, significant investments, and acquisitions. Also oversees operating plans, capital budgets, and the company's financial reports to common shareholders. In the United States, boards typically have 10 or 11 members, with the company's CEO often serving as chairman of the board. In Britain, it is common for the roles of chairman and CEO to be kept separate, and this idea is gaining support in the United States. The Sarbanes-Oxley Act of 2002. Governments and regulatory bodies around the world continue to focus on the issue of corporate governance reform. In the United States, one sign of the seriousness of this concern was that Congress enacted the Sarbanes-Oxley Act of 2002, SOX. Sarbanes-Oxley mandates reforms to combat corporate and accounting fraud, and imposes new penalties for violations of securities laws. It also calls for a variety of higher standards for corporate governance, and establishes the Public Company Accounting Oversight Board, PKOB. You can get a copy of the Sarbanes-Oxley Act of 2002 in the link provided here.
Chapter 1. Corporate Governance Concepts. The Basics of Corporate Governance. Let's take a look at some important questions regarding corporate governance. We will start with, what is corporate governance? There are many definitions aimed at encapsulating the spirit of corporate governance. Corporate governance is simply described as the process by which organizations are directed and controlled in terms of authority, accountability, stewardship, leadership, direction, and control. Corporate governance is more comprehensively described as the framework by which a company's board of directors and senior management establishes and pursues objectives while providing effective separation of ownership and control. It includes the establishment and maintenance of independent validation mechanisms within the organization that ensure the reliability of the system of controls used by the board of directors to monitor compliance with adopted strategies and risk tolerances. Why is corporate governance important? The implementation and maintenance of strong corporate governance policies ensure that proper oversight is in place to hold the organization accountable to the standards, laws, and regulations that it should be abiding by. Effective corporate governance helps an organization to achieve its objectives and desired outcomes and fulfill its obligations through sound strategic and business planning, risk management, financial management and reporting, human resource planning and control, and compliance and accountability systems. Effective governance also helps provide a framework for establishing responsibility to all of the participants connected to the organization spanning clients, employees, and providers of capital. An effective corporate governance framework is essential to a banking organization's overall safety and soundness. How is corporate governance assessed? Assessing corporate governance can be classified into 4 general topic areas: structure effectiveness, board supervision adequacy, management effectiveness, and adequacy of control functions. A 3-tiered rating system of strong, adequate, or weak is commonly used to summarize the results of an assessment. A review of structure effectiveness targets the organizational structure through a top-down review of legal entities, individuals, and policies. More specifically, it focuses on how clearly roles, responsibilities, and lines of authority, as well as communication channels, are reflected in the legal structure of the institution. In addition, it considers the quality of the ethics policy and the code of employee conduct established by the board to guide the actions of management and employees on behalf of the institution. A review of the adequacy of board supervision focuses on elements that demonstrate the ability of board members to understand and oversee the activities of the organization. Board charters are reviewed to understand the legal requirements that are established for the board by the shareholders. The assessment of board committees focuses on how committees are structured, the quality of minutes, and most importantly, the quality, frequency, and timeliness of information flow to the full board. Given the importance, additional attention is placed on the activities of the audit and governance committees. The evaluation of board supervision adequacy also considers board members and their qualifications, the reasonableness of compensation practices, the quality and accuracy of board minutes and reporting, and the adequacy and frequency of training and self-assessments. And finally, a thorough review will focus on board member attendance. Evaluation of management effectiveness centers on management committee charters and activities and line of business metrics. In particular, the review of this area focuses on the qualifications of committee members, the scope of committee activities, and the flow of information to the board. Line of business management, through self-assessments and other reporting systems, can provide useful information to the board of directors regarding risk profile and valuable insight for setting strategy. So, for institutions managed by line of business, which are typically the more complex institutions, the quality of self-assessments was evaluated. As control functions provide an independent assessment of the quality of internal controls and risk levels, their effectiveness and relationship with the board is an important component of corporate governance. In this context, evaluation of the adequacy of control functions focuses on the efficacy of the internal audit, external audit, credit review, and compliance. A three-tiered rating system of strong, adequate, or weak is commonly used to summarize the results of an assessment. A strong rating reflects that for all or a significant majority of the characteristics reviewed for each element, the institution performed at the highest standards possible, and no characteristics were rated weak. An adequate rating reflects an institution generally meeting expectations for each element, but could have anywhere from one to a few instances where individual characteristics did not meet expectations. These shortfalls could be easily addressed in the normal course of business and would not be significant enough to adversely affect any supervisory ratings. A weak rating reflects the institution had one or more characteristics where there were serious shortfalls in meeting minimum expectations. These shortfalls would require significant efforts to correct and could negatively affect an institution's supervisory rating. Now that we have answered some basic questions about corporate governance, let's take a look at the role that banks play in world economies.
It is important for us to understand the role that financial management plays in the operations of a firm, whether it is manufacturing, marketing, finance, or accounting. This is how my small firm's financial management function will look like. On top is the shareholders. This is in response to the heightened concerns over shareholders' interest. Below the shareholders are the board of directors, followed by the top executive officers led by the president as chief executive officer, CEO. There are 3 executive vice presidents, in the operations, marketing, and the chief financial officer. Reporting to the chief financial officer is the vice president as treasurer and controller in one. As a treasurer, he is responsible for capital budgeting, cash management, commercial banking, and investment banking relationships, credit management, dividend disbursement, and share repurchases, investor relations, insurance/risk management, mergers and acquisitions analysis, pensions management, tax analysis, and planning. As a controller, he is responsible, cost accounting, cost management, data processing, general ledger, payroll, accounts receivable/payable, government reporting, IRS, SEC, internal control, preparing budgets, preparing financial statements, and preparing forecasts. To summarize, financial management deals with the purchase, financing, and management of assets with a specific aim in mind. Financial management's decision-making role can be divided into 3 categories: investment, finance, and asset management. The firm's purpose is to increase the wealth of the firm's current owners, or shareholders. According to agency theory, managers, agents, particularly those of large, publicly traded companies, may have goals that differ from those of shareholders, the principals. The mechanism through which corporations are administered and controlled is known as corporate governance. It includes the company's shareholders, board of directors, and senior management relationships. That caps the introduction to financial management. I hope you learned a lot. Here are my references. 1. Fundamentals of Financial Management, 13th edition, authored by James C. Van Horn, and John M. Watch Alex Jr. 2, and a number of YouTube videos. Thank you for watching. This is Irine signing off. Until then.